Welcome to the Risk Reversal Podcast. I'm Dan Nathan. That's Guy Adami.
I am.
We're going to have one of our little vibe sessions here, Guy Adami. Hot 30, as you like to say.
Vibe session. You know, I've embraced that terminology.
That's good.
Because we learned about vibe coding a couple weeks ago.
And we looked at vibe recession. Remember that Kyla Scanlon had that thing a couple years ago?
Yes, she did. She did. And she then, I'd like to think that we sort of discovered her, although she was discovered prior to.
We can't take credit
but then
for that.
what do you call when people blow up on the internet?
She blew up on the internet.
Yeah, that's what she did.
She was great. Actually, she's a great follow on the Instagram. I'm not on the Instagram, but I hear she's a great follow. If you go follow her, she's got these
You
vertical.
stepped away from the social media.
I did step away. I'm out on everything. You cannot find me on the
No
socials.
footprints.
I've been that way for a while here, Guy. I tried to dabble back into the Twitter. It's just a cesspool. I'm out. All right. You and I are going to focus on a couple things here. The S&P 500 is down 1%. The NASDAQ is down 1.25%. We are about an hour away from the close on Tuesday. This is the first trading day of September. Guy, it's that month in the of the year in the markets.
People get a little freaky in September.
Why?
Well, the summer, people in the summer, things get laid back. They come back in September all raring to go. You can see the finish line in terms of year end. A lot of funky things historically have happened in September and October, and a lot of people have talked about that. I will tell you that Friday, which was month end, that would be the last trading day in August, there were no markups on that Friday.
Yeah.
And we have seen the markets get marked up into month end, quarter ends many, many times before. So that was interesting. And here we got the month started off, somewhat lackadaisically. But what I will point out, on a day where the market's only down 1%, and that's not a big move, you have a VIX that's now right back above 18. Yeah. So there are things happening without question.
Yeah, and so, that's the equity market. Let's talk about the bond market. This is something that you've been really focused on over the last few weeks, and I think it goes back longer, and you've been obviously making the case as the CME Fed Watch tool has been kind of handicapping what the Fed's going to do at this September meeting. We're back towards a near certainty of a 25 basis point cut. You've been saying the Fed, they can control the short end.
Have at it.
Well, you could say they are controlling the short end, but what's going on the longer end, and now we have a 30-year Treasury yield nearing 5%. Okay, so this is the kind of the upper bounds, Guy, of what we've been at for the better part of this year. But you've also been focused on, 30 years around the world. Yeah. That seems to be what the stock market here is keying off of today.
I'm going to try to make September a clean month in terms of my vocabulary.
Okay.
So I'm going to do my best not to curse. However, the global bond market is definitely calling bullshit on all these rate cuts. And there have been rate cuts around the world. Obviously, we're anticipating one in the United States in the next couple of weeks. We'll see if that comes to fruition. The market is saying there's certainty that it will. I agree with that. But the back end of the curve is challenging that. And for whatever reason, the equity markets have not been all that focused on it. For some reason, they're seemingly focused on it today. The problem, of course, is I don't think it's by any stretch going to get much better. I think you can cut rates around the world. I think you can try to go on a rate-cutting cycle here in the United States. I don't think that's going to do anything to help the problem, of course, being the back end. And the problem in the back end is that's where everything gets financed. Mortgage rates, auto, you name it, that's where things get priced. And that's not getting better anytime soon.
All right, so can you talk to me like I'm an idiot on a day where you're seeing...
Well, you're not, though.
I know, but just talk to me like I am just for a second here. Why does, when you have longer-term yields going higher, why does that weigh on high-valuation stocks like the NASDAQ?
Because, well, in my opinion, it's the market's way of sniffing out what's really going on. Yeah. Again, the back end of the curve is where things are actually happening, and the back end of the curve is pricing in a number of different things. It's obviously not focused on weakness in the economy. It's focused on a debt problem, which is now making its way around the globe, and it's focusing on a U.S. debt to GDP, which is probably approaching, 122%. And, the line in the sand historically for countries is about 130%. And I think that's what the market is sniffing out. Now, people will say, wait a second, Guy. Today's move is predicated on this notion that the United States is going to have to give back all the tariff income they got, and there's some semblance of that going on. Maybe that's part of it, but this has been going on long before those conversations were being had. So it's just this culmination, this collective piling on effect that's going on again, not only here in the United States, but globally. I mean, look what's going on in the UK. Look what's going on in Germany, France, Spain, Japan. It's a laundry list of countries whose back end of the curve continues to ratchet higher.
All right. And so the other answer to that question, I'm going to talk to myself like I'm an idiot. So when you hear about these like high valuation tech stocks, right? So why do they have high valuations? Well, they're actually, you're buying them now for the hope in the long term you're going to get paid back, right? They're going to grow into their evaluations, right? And so the best example of that might be this data center build out, right? When you think about it, you're basically asking investors right now to say, you know what, you got this, right? Like we're going to take your money and we're going to keep raising money and we're going to build out these data centers and we are going to be well positioned for the long term because AI is going to change the world, right? But if you have long-term rates going higher, that will put pressure on the valuations because those cash flows that you're basically working towards in the long term, right? Isn't that another way to think of it?
That's part of it.
Right.
I mean, Doug Cass talks about discounted cash flows and the cost of capital and the equity risk premium. That all plays into exactly what you're talking about. And again, when rates are tame, nobody cares about valuations. Jerome Powell himself said, in a zero interest rate environment, valuations don't matter. Go back to the Google machine or Grok or whatever people use these days and find out. Problem, of course, is we're no longer in that zero interest rate environment. Rates have gone up in a pretty dramatic fashion in some places. Now, valuations are starting to matter. I think there's been this misguided hope that if the Fed were to start cut rates, everything would fall into place. But that I don't think is going to happen. And quite honestly, I think there are people at the Federal Reserve that understand that. I actually think there are people in the administration that probably understand that as well. But the politically expedient thing to do and say is the Fed is really hurting us. It's hurting your ability to buy a home. They need to cut rates. The reality is it's just not that simple.
Right. So as we further decode today's weakness, and again, we're down 1%, right?
It's not a
I know. Yeah. So this would be if the NASDAQ closes down 1%, it'll be 2 consecutive closes down 1%. We haven't seen that since April. The other thing I think is worth noting is that Friday after the close, you had this appeals court come out and strike down a bunch of the Trump tariffs, saying that they were illegal to be put through under this Section 232, that sort of thing. It's worth noting, though, that a bunch of the tariffs, whether they be steel and autos and all that whole kind of infrastructure, copper, obviously, those are excluded, okay, from that. So what they're doing is they're basically saying that these across-the-board 10% tariffs and then these fentanyl, these punitive ones. Now, one of the reasons why you might see the 30-year rallying a little bit is because one of the cases that the administration has been making, right, they're spending a lot of money right now, but they were going to take in, they were saying trillions of dollars, right, on all of these tariffs. So if you take that away, I'm just saying hypothetically, okay, then you're thinking about that exact debt pile that you're speaking of, that debt to GDP, right? If you can't finance or you can't pay that debt service based on, you have to do it off a deficit, well, that should make long-term rates go higher too. Is that
No, I think you hit the nail on the head. I mean, the trillions of dollars we're taking in, people throw things around. The reality is we're nowhere near that, but that's neither here nor there.
That's what they're saying.
No, I know that's what they're saying. And nobody seems to want to do the work required to sort of get to the actual reality of the numbers. But with all that said, the global bond markets are telling a story. Tariffs, no tariffs, clawbacks, no clawbacks. This has been going on for quite some time. And I think we're at the beginning of the equity market starting to sniff this out. Now, to me, the continued tell will be how some of these auctions go, what continues to happen in terms of Europe, which on a daily basis, we're making highs we haven't seen in decades in terms of yields. But more importantly, is the VIX going to start to tell a story? Now, I was shocked that it got down to a 14 handle, but it's seemingly reaccelerating, again, north of 18, in an environment that is, I would say, again, somewhat benign in terms of the S&P 500. A move of this magnitude in the VIX historically suggests instead of down 1%, we'd be down 2.5%, maybe 3%. We're nowhere close to that.
All right. So then at the end of the week, Guy, we're going to have the all-important August jobs report. And if you go back to August 1st, when the all-important July
I love everything's
jobs report. That was really the last bout of volatility we've had, right? If you think about it in the equity market. And so what happened then, we know that the July number came in very weak and they had a revision lower of, I think, June and May. And President Trump fired the commissioner of the Bureau of Labor Statistics. He said the numbers were rigged.
Yeah.
Okay, so here's the first report since the commissioner was sacked. And so I ask you this question, Guy. Will those revised numbers and the July, will they get re-rigged? Will they get re-rigged here? Because, listen, we're joking about that, but we're likely to see an unemployment rate at 4.3.
Yeah.
Okay.
That's expected.
That's up from 3.6%, early last year or something,
Yep.
which was like a 60-year low. So we've seen it ticking up. We've seen the data get weaker and weaker across the board, not just the labor data, right? But we're seeing other data. We had the ISM this morning that shows 6 consecutive negative prints.
Contraction.
We are in contraction right there. And again, you and I, we're not trying to make some crazy case that the economy is about to fall off a cliff, that we're going to finally get that recession. But I guess what I'm more focused on is what is the confidence, okay, that investors, or more importantly, companies that are investing in this country, whether you're from abroad or whether you're here, if you can't trust the data. Now, I get it. If you listen to, and we had David Rosenberg on the podcast, I want to say shortly after that number came out, it's not the BLS, okay, that's doing this. It's the respondents to these surveys, right? And so if you don't have responses and they do revisions and you get more responses as it goes, it's not like some plan, you know what I mean, to deceive anybody. So I guess my case to you is the market right now pricing a potential outcome on Friday morning that might be something that you and I have not seen in a very long time?
Yeah. Well, I think the number is expected to be about 75,000 or so jobs created in the month of August, which is basically what we saw in July. Obviously, things are getting ratcheted down. By the way, that's normal. I mean, that's just the economic cycle. That's the business cycle. That's what we should be seeing. In terms of the revisions, I don't know how it plays itself out, but your point is exactly right. It's the way that these numbers are tabulated that's the problem. It's not the people that are then reporting the numbers. I mean, you can say the process is flawed. The problem, of course, is the administration said the numbers were rigged. What they should have said, in my opinion, I'm not a politician, but they would have said, you know what? It's clear we can't have 250,000 jobs revision because so many decisions are based on these numbers being accurate. We have a problem with how things are done. Unfortunately, when you run a department of that magnitude, somebody's got to take the fall. It's not a question of revised up or revised down. It's the scope of the revisions that we're concerned about. Therefore, we're going to have new leadership. That's not what they said. My point was, if they had revised those jobs higher by 250,000, would we be having the same conversation? And the obvious answer is absolutely not. It was a downward revision that got people concerned. So I think the jobs market is going to continue to deteriorate. I think 4.3 is going to turn to 4.4. And I think before you know it, we're going to be staring at something that's going to approach 5%. I don't know if it's by the end of this year or early next year, but that's where we're headed, because when the job market starts to turn, you really can't slow it down. Liz Thomas talks about escape velocity. I think that's what we're about to see.
Well, there's two obviously ways in which companies have to fire people, right? So in the private sector, you just see an economic slowdown. You see in the case of this tariff war, right? You have to pass through higher costs through a consumer, or you have to eat it. And once you're trying to do both, at some point you have to kind of fire workers. So we've seen that, right? So in the private sector, there's a whole host of reasons why companies have to fire people. The irony here about this data and the folks that are complaining about it is that DOGE has targeted hundreds of thousands of federal workers to cut. Supposedly, they've already cut maybe 200 to 250,000. Look at the revisions that we had in May, June. You know what I mean? It actually kind of falls within that number. And so, I mean, listen, I'm not trying to be snarky about that, but the idea of shooting the messenger when you're
exactly
actually
right.
taking folks around back and you're moving them out of their jobs, just to say that, I guess, as politely as possible, it all kind of comes together a little bit. And I guess the worry that I have, guys, that we haven't seen this in a long time. We've never seen it. So on Friday morning, if we see eye-poppingly strong numbers, there's another way to think about it.
Market won't like that either.
Well, they won't like it, but also, what does it do to the Fed? What does it do to the Fed if you start to see all of a sudden revised up and strong data? Then they're not going to actually have the case to cut interest rates.
Your point about confidence, though, I mean, that's really the crux of this entire thing. Like how everything in our economy is based on confidence. Confidence that outsiders who buy our debt, who finance the way we run the country, if that confidence wanes, it's not to suggest that they're not going to buy our debt. They will. They'll just do it at a higher rate of interest. And that, again, goes back to why I think rates are going higher. So if the entire thing is a confidence game and the numbers start not to make any sense at all, the market participants will sniff that out. More importantly, the counterparts will start to sniff that out. And the bond market, you call them vigilantes, whatever you want to call them, will absolutely start to sniff that out. And then it all becomes counterproductive because yields will continue to move higher. The Fed can't control it. The stock market at some point reacts to it, and then you have yourself a problem.
Well, here's a problem. So just going back to this appeals court that struck down these tariffs, right? So they remain in place. So the administration says that they're going to appeal this, and it's going to go likely to the Supreme Court. So this is probably one of the first big tests of this Supreme Court. Trump has put 3 of these justices on there, and let's just say they get a ruling that they don't like. And let's just say
the administration,
and let's say they choose to ignore it. And we've heard this again and again. Constitutional crisis.
Yeah.
What does that mean? And we're not going to debate that right here. But then let's think about, okay, so that's the here and now. That's going to take a little while. Then we have all this data that we talked about. Then we have CPI and PPI on the inflation front. Then we have a Fed meeting on September 17th. And then you know what we have at the end of the month by quarter end? We have a debt ceiling situation here. Again, so you put all those things together, it really does speak to confidence. And the point that I think you just made is if folks lose confidence in each one of these situations, the Supreme Court and what could be a ruling going against the administration, a Fed that is losing or the administration is trying to take away their independence, and then an old school, political brouhaha where it really comes down to horse trading, right? And so, this could be a September to remember.
Don't say it.
This
Don't
could
say it.
be
because you're trying to name this.
But let me ask you this. Is there a part of you that wants to say, Dan, wake me up
when September ends?
Is there a part of you?
I was waiting for
is there
both
a part
of those
of
things. I was hoping, against hope as it turns out, that it wouldn't come.
You know what's interesting? I am going to see Green Day in concert on September 28th.
They're still a band?
Stop it.
No, I don't know these things.
They're not only still a band, they're a great band. They remain a great band.
American
they're
Idiot,
probably
right?
one
Wasn't that one of the most influential, most important albums ever made?
It was an amazing album.
Did they make like a musical about it?
Yeah, they did.
The Broadway.
You know how many times I saw it?
8.
I saw it about 8 or 9 times.
That was
and the
a guess.
last night,
Turns out
by the way,
right,
so the last night that they played, so Billy Joe Armstrong joined the cast, I want to say mid-run.
Is he a Green Day person?
Stop it.
No, I don't know these
He's
people.
the lead singer of
I don't
Green
know
Day.
this Green Day.
I don't know this Green Day. I don't know what they do.
I don't have, hold on a second.
So the last
Keep talking.
night.
I'm pretty sure I don't have any Green Day
So the
songs,
last
though.
night of the run of the play on Broadway, the band played a concert right after the show.
Stop it.
Yeah. And Ellie and Alex went with me. This must have been 2011. They were both really very young, and they were huge Green Day fans. They remain so. So we're not going to do either of those in September.
Well, you just did them already.
Guy, there's a lot going on. I mean,
September's an important month.
Yeah.
Listen, in terms of the debt ceiling, I agree with you, but you know these things.
I know,
they
we've
go
been doing this
11th
for
hour, and
15
then
years,
they figure it out. And so, but all the other stuff is, I think, a point well taken. And again, there's a cumulative effect to all this stuff as well. And I think that's what you're starting to see. And it would give the rest of the world great pleasure, and I mean this sincerely, to see the United States have some sort of problem. They will not say that out loud, but I mean, I think there is a concern. Listen, amongst our economic enemies, that's clearly something that's going on. North Korea, Russia, China, you want to throw in a couple other countries for good measure.
You know
that's
what you
fine.
could throw in?
I think you throw India in the mix as well,
I
because I think they're pretty pissed off at us now as well.
Did you see? I mean, this was on the cover of the Wall Street Journal, the New York Times. It's Putin, it's Modi, and it's President Xi, and they're all holding hands. I mean, it's a pretty awkward-looking picture. And so there was a lot.
Speaks volumes.
Well,
though.
there was a lot written over the weekend about what the administration has done to India. They basically wreck relations that we've worked very hard on for the last 25 years. And even think about this: a few months ago, you know, the president and all these folks were cheering the manufacturing that had been moved to India from China. And now all of a sudden we're in this situation with India. But why? Because the Indians were buying oil from Russia.
Yeah.
And you know what the fucked up thing is right here, Guy? And I just broke your little promise here.
Well,
Maybe it was my promise. Yeah. The most amazing thing here is that our tariffs, ready for this, that we have on Russia are less than what we have on China and on India.
That's well.
So help me understand that.
Well, those Russian tariffs are a knock on China and I mean it's directly. I mean it's sort of secondary, but yeah, you're exactly right. I mean, look, tariffs against Russia in terms of the economy is a pimple on my ass, which is a very attractive thing, I'm sure, but it's not a big deal. Is my point. When you're talking about India and China, though. That's a big deal. So how do you? They're pissed off at China and India for buying Russian oil. How do you get around that? By creating these things, which are headline against Russia, but it's got nothing to do with Russia. I know,
but we had President Putin on U.S. soil less than 2 weeks ago. Okay,
have you been to Alaska?
No.
Any interest?
If we have any Alaskan listeners here, I probably
sure we do. We
won't
had somebody from
there.
Alaska.
If we ever took the show on the road, the Risk Reversal podcast, would maybe Anchorage,
go to Juneau or
Anchorage. No, my point is like the whole idea of levying tariffs.
Right.
Okay, whether you'd first start out with your political adversaries. Okay, some of the trading partners that you think have been ripping you off. If you're listening to that, I'm saying it into air quotes because we could talk about trade deficits, Guy. The trade deficit you have with your barber, you know, that sort of thing.
I do.
Pretty simple. Okay, my point is though, you do it. It's a projection of power. It's leverage. It's something, you know, that sort of thing. But the fact that we are using them, okay, against our allies in a way that is not instilling a level of confidence as us as a partner. And this goes back to what you were talking about. There's many countries around the world that would love to see us get into a little bit of a...
I agree with that.
Well,
by the way,
but that's what the Chinese, by the way, they're nonstop like talking to their people or portraying us as a bunch of bumbling idiots and how our form of capitalism sucks.
I'm not going to try to excuse it. I think in terms of going after our closest allies, I think the thought process may be if our adversaries see how difficult we're being with our friends, what could they possibly do to us? It's not unlike the baseball coach that goes after his star player in the middle of the locker room or the clubhouse. All the other players see that and say, well, if he can go after Aaron Judge, then he can go after me as well. So I think there's a mind. I'm not saying that's right or wrong, but I think that's part of the thought
my only
process.
point is like China is the one we're most focused on here.
Rightly
and
so.
If anything, we've taken a step back there. Russia on multiple levels here. Obviously, their invasion of Ukraine. It looks like we're being tougher on Ukraine than we are on Russia to end the war. And then if you think about what's gone on with India, okay, we can put a pin in all that. But I just think all three of those things, not that they have to go the same way, not that they're going to have the same sort of effect if they do go in an adverse way. Who knows? All right, let's
real quick.
Yeah.
I mean, again, I'm not comparing, but you can go back to the late 1920s, 1930s, and people talk about Smoot-Hawley to the extent that you've ever seen the movie Ferris Bueller's Day Off. It was talked about in that movie, and it's starting to come up again. When President Trump was civilian Trump, if you go back in the 1980s, if you remember, Japan, I think at the time, was the second largest economy in the world, and they were kicking ass across automotive, electronics. They were doing it. It was Japan's world. If you go back and listen to some of the things then, again, Citizen Trump was saying, he was saying how we're getting ripped off by the Japanese. Obviously, China is today's Japan of 30 or 40 years ago. So it's not like he put it out there 40 years ago. Yeah. The problem, of course, is, as you said, just because we buy more of their stuff than they buy of ours does not mean by definition that we are getting ripped off. We are an economy that buys things. We are not an economy that makes things, and that's just how it works.
Yeah, and we're consumers. I mean, if you think about it, I think 70% of GDP here is consumer spending, and we have a savings rate of less than 5%, whereas the Chinese obviously are the manufacturer to the planet, okay, and they have a savings rate of 40%. That is what it is. All right, before we get out of here, Guy, let's just kind of put a bow.
I like bows.
On
you put a bow on something before.
No. All right. No, I think I did that in Market Call. Didn't I put a bow on something?
Track.
All right. Let's tie a bow on this whole thing. Stock market, we're maybe 65 basis points off the lows. The S&P is down a little less than 1%. Mm-hmm. I'm looking around the market here, and I see some stuff. Let's start with FedEx and UPS. Mm-hmm. They act like we are in a recession. Yeah. They act like, if you're just looking to project some things here, they're both down about like 3% or something like that. And so I just wonder, how do they fit, in your opinion, into this back and forth trade tariff situation here? Like, there's got to be some impact going on there.
Say what you want about transports no longer being as relevant as they were when the whole Dow transport theory was brought forth. With that said, they are still very economically sensitive names. Now, the optimists will say, you know what, these are FedEx and UPS specific problems. They're just not run properly. And there's definitely some truth to that. But a FedEx, for example, that's trading just off the April lows. I think the April low is about 210-ish or something like that, maybe 205, and we're trading 223. That, to me, is not particularly good, given some of the bounces we've seen in other names that have been historic. UPS is just in a completely different animal. We're talking about levels we haven't seen since 2020, the spring of 2020. UPS has been an abject disaster. Now, again, a lot of that is UPS specific, but a lot of it is also very economically sensitive. There are things going on in their world as well that are somewhat out of their control. Market doesn't care. That's fine. When does the market care? Well, if you watch the networks during the day, they're not really talking about this yet. I don't know when they're going to start, but they should be paying attention.
Yeah, no doubt. I want to hit a headline that I thought was really interesting. This is on Taiwan Semiconductor. And again, we know that, Taiwan Semi, they make 85-90% of high-end GPUs. And this was a follow-on to an announcement that was made last week by the U.S., or by us, to Samsung out of South Korea. And so here's the headline today. This is from Bloomberg. U.S. pulls TSMC's waiver for China chip supply shipments. So TSM has one facility in China, on mainland China. And, this headline kind of struck me a little bit because, a lot of our positioning with China is to defend Taiwan. One of the reasons why we would want to, at least verbally to start, to defend Taiwan is that most of the high-end chips for the planet are made at a Taiwan Semi facility, or for the most part on Taiwan. Now, they have this one facility in China, and so the idea that we would revoke these licenses for Taiwan Semi to send supplies into China, they need to get approval from us, just seems like a really weird situation, because it feels like it's almost penalizing Taiwan Semi more than it is the Chinese.
It is. Yeah. I mean, what do they call it? I think it's validated end user status or something wonky like that. Yeah, I do. Listen, I get it. Everything is directed at the Chinese. Well, in this example, the problem is you're probably not wind up hurting them. It probably, to your point, hurts Taiwan Semi more. I don't know who comes up with these things, and maybe they are playing some form of chess.
Sounds like it's a Letnick thing here, probably.
Probably. Yeah. But I just, you look at it at the surface and you try to make heads or tails of it, and it just doesn't make a lot of sense to me. Again, and you want to sort of stoke the flames between what's been going on with the United States and China, then China-Taiwan has its own issues. I mean, it's just you're poking the bear here.
Yeah, and, I think we made this point last week. So Nvidia, since it reported, barely seen an uptick. Now, I don't mean it's gotten killed, but at its lows today, it was down 8%. Taiwan Semi is down 8%. It hasn't made a new high since its earning. Microsoft is another really interesting one, Guy. It traded as high as 555, that huge gap after its earnings. I'm going to say that was like July 31st or something like that. Traded 555. You know where it's trading right now?
505.
Yeah, 505.
So 555, 505 minus, that's 50 against a 55, so that's probably 9.3%.
Nice, dude.
But so I did there, Bill? That was
so
math.
The reason why I brought those three stocks up is that they have been three of the largest beneficiaries in market terms or market cap terms in the last 3 years as it relates to generative AI, and they've all hit a bit of a speed bump. So I just think that's worth noting here. Last one, Guy, in an environment where you are gonna get your 25 basis point cut on Fed funds, but you see the 30
me or just market, just you say you as in like everybody.
One.
Right.
If it's
no, you are gonna get.
Correct.
So I'm not getting anything.
Well,
the market's going to get their 25 basis point cut.
Right. And if you're going to see that 30-year start to tick
that's
up a
problem.
little bit.
You're gonna, that's what you're going to see.
So tell me, though, what does it mean for net interest margins on the banks, right? Like, come on, Guy. I mean,
they're going to people will start to point again. The yield curve is working to the benefit of the banks.
Yes.
And there might be some truth to that. Of course, the flip side of the equation is if the back end of the curve is going to start going higher, it's going to curtail economic activity, which is more than makes up for the net interest margin and the theoretically favorable yield
That's
curve.
all I wanted to do is kind of
that's like an economics class I just gave.
I just
Bill.
wanted to twist you in a little bit of a
you
pretzel
didn't,
there.
But I
you know
untwisted myself.
You did. You're untwisted. All right.
I'm untwistable.
You're actually a little twisted.
No, I'm not.
Up here.
I'm getting my hair cut tomorrow.
I know. I'm actually also doing that. So tune in on
have
Thursday to the market call. You're going to see
we
us
both
with
have
some
haircuts.
We'll also be on the Fast Money this week. So tune
sure.
in for that at 5 o'clock Eastern tomorrow
Melissa
afternoon.
Lee's back. Karen Feinerman's back. Tim Seymour's back. They were all on Halls.
You and I were
the British call it Hall. You're going on Halls.
Yeah, that's
it's like holidays. You know what? Seriously?
Yeah.
And what they put S's on the back. Like for example, if you work at J.P. Morgan, they say you work at Morgan's. Why do they do that?
I don't know. We're gonna have to ask
we
our
have
friend
Wilf
Wilf.
back?
Yeah.
I work at Morgan's. You're also an asshole.
You just said you weren't going to swear.
I know. It
Okay.
didn't last long.
All right. On that note, we're going to get out of here. Thanks for being here, everybody. We'll see y'all on the Fast Money, on the Market Call, and more of the Risk Reversal podcast all week. Thanks.